Everybody, it's Dan Bouchard. Hope you're doing well today. And we have got tax masters with us to start our presentation. So take it away. Oh, okay, great. Let me go ahead and get my PowerPoint pulled up here. So we can. There we go. Sharing's not turned on. The host is allowing. This is the host. All right. Isn't allowing sharing for this meeting. This one. Oh, come on. I don't know what to do. Like stop. This is the host. Oh, the reclaim host. Oh, there it is. There we go. Fantastic. Fantastic. All right. Here, Yep. Hold on, we're gonna do this. We're gonna have to do this, guys. You ready? Usually, Okay. 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 It's like, not giving us any problem. Signing to get started with PowerPoint. Office. If you log into my account, I guess. I don't even know what my password is. Okay, there it is. Tell me that's, no, it's. Yes. Oh, there we go. All right. That's not right. We're in my PowerPoint. All right. Let's get. From the beginning. There we go. Hopefully everyone can see that. I'm just gonna test this out. Yeah. You see? Yep. Backwards. All right, everybody. Good morning. Let's see. Where can you see? There we go. Yeah, it's a little cold in here, so I'm gonna stick with my sweater and my jacket today. So forgive me for that. But Preston Hall here from Tax Masters. We've been around for since 1967, so about 56 years at this point. And we specialize in real estate professionals and real estate investors. We are not here to do the hard sell. We've been in business a long time. We have more clients than we can handle. Just here to teach you all a little bit something about taxes, save you some money. And if you do need tax help, then we're here. We're happy to fire any doctor clients or lawyer clients to take on a real estate client, because that is our specialty. Go ahead to the next slide there, Preston. Speaking of which, my kids are here today. They had 2 hour delay, which reminds me, and I'm going to give you a bit of an abbreviated version since we started late today. But hiring your kids is a fantastic tax deduction if you have an S corp or if you're making good money. That can be a very effective tool to save you some money. Go ahead to the next slide, please. All right. So we'd like to start off with this little quote from Albert Einstein. This is from when he emigrated to the United States, and he was not able after weeks to figure out how to do his tax return. And he sent it back to the IRS because back in those days, they'd send you a blank tax return and you'd fill it out yourself. And said, you all figure this out. And we all know Albert Einstein was a genius, but he was not a tax professional. You folks are real estate professionals. You're not tax professionals. So we do not want you giving tax advice to your clients. All right? Because I can give you the answer to most tax questions. And the answer is, press the next slide. It depends. Depends. So you really can't give an answer to a tax question from your client without looking at everything that has happened in the past, everything that's going on right now, and what they're trying to accomplish for the future. You folks are real estate professionals. You don't know how to do this. It takes us years and years to get even mediocre at this. So we don't want you folks getting sued. You should have a tax professional that you can work with, where you can send your clients and be confident that they're getting the correct advice, so that they are your clients for the next time they purchase property.
What's your means of communication?
So, go ahead to the next slide. Can we, can everybody mute, please, if you're not speaking? Thanks. And on that note, if anybody has questions along the way, I'm happy to answer them. You will need to give us a sec, just due to the audio. I may ask you to repeat your question. I do love questions, and I'm happy to answer questions at the end as well. So here's some recent tax law changes. Let's see here. We've got 2.5% jump in tax brackets. With inflation the last few years, the tax brackets have actually jumped a lot more than 2.5%. This year we just get a small one, what that means is if you're making the same this year as you were making a few years ago, you're actually going to be paying less in taxes. So that's, I guess, the only good thing about inflation is that we do get jumps in those tax brackets. So it takes you more income to get into those tax brackets. We've got the beneficial owner information reporting, and this is one of those things I don't really, if you do want to ask questions at the end, we'll talk about it. But if you own your own sole member LLC, you own your own S corp, your own partnership, you need to be filing this beneficial ownership information report. It was actually due back in December. There's already two decisions in just December, right around Christmas time, saying you don't have to file it and you do have to file it. Currently, you do not have to file it, but if they bring the requirement back and you own a business entity and you don't file, the penalty is $500 per day. And there's also jail time associated with it as well. I believe that this is going to get completely struck down, but it was a bipartisan bill that this got passed under a few years ago. So we'll see where this goes. I try not to send out a lot of newsletters. I try not to spam people, but this is one of those things where I've been keeping my clients abreast of what's going on with the beneficial ownership because the penalties are so severe. So if you go to our website and you sign up for our newsletter, I'll at least be keeping people abreast of the court cases that are going on with this. This is not a tax thing; it's a legal thing. But because as tax advisors, we're dealing with our clients on an annual basis. So I do like to keep people abreast of this. Not a lot of people talk to their attorney on an annual basis. So, all right, let's see here. These are pretty big lately. Energy efficient home improvement credit. If you're getting heat pumps, windows, doors, things like that, there are pretty good credits associated with them. So if you're doing that, if your client's doing that, make sure you have them or yourself talk to your tax professional because there are some tax savings associated with doing that. Go ahead and go to the next one. Oh, actually, go back one person for me. And can you click got it right here for me? Oh, put it up here. You can't read it on the glass. There. Oh yeah, and then we've got the clean energy credit. This is huge. If you've got clients who are getting solar panels or geothermal, this credit is absolutely enormous. It can be up to 30% of the cost. So I mean, this could be over $10,000 credit in some cases. Now, in 2025, as we understand it, the installer is going to have some sort of PIN code when you go to file for this credit. So if you're having solar panels installed or geothermal or your clients are, make sure that they're working with somebody that can provide them that registered PIN code so that they get this credit. This is one of the only things we've seen correspondence audits on in the last year is because the tax savings are just absolutely astronomical with these. All right, go ahead to the next one for me, Pete. All right, some other recent changes. If you're putting a vehicle charger in at your house, if you live in what is deemed a low-income urban area or a rural area, you can get a tax credit on these, and the map is all over the place on this. So with any client who's putting in a vehicle charger, we go ahead and make sure we put their address into the map to see if they qualify for this, because you can be on one side of the street and qualify and another side of the street and not qualify. It's very strange the way Department of Energy has set up the map on this. Electric vehicle credit, still going on for the time being. You can get up to $7,500. There are income limits, but if you own your own business and it's a business vehicle, there is a tool in which you can go ahead and take that $7,500 credit, even if your income is above those limits. Last decade, we've had a significant downward trend in audits. The audits that the IRS is doing, they tend to be correspondence audits where the computer picks up something and they just send you a letter saying, hey, can you send us proof of this one deduction you had, or we have that you have more income on file. And so those are pretty benign audits, relatively easily dealt with these days, much less scary than an in-person audit. In-person audits have really gone down to, there are very few of them. The IRS doesn't have a lot of staff to do it. So if you're doing a tax return, if you're having it done properly, there's a very low chance that you're going to be audited. We've only seen 2 audits
in the past 6 years. And both of those clients, we had told them beforehand, years prior, we said, look, these returns are going to be audited. Make sure you have all the documentation for the things that we're doing, because your business really isn't set up the way that we think it should be. You'll be audited, but there will be no tax due, and that's exactly what happened in both of those cases. So, all right, Preston, go on to the next slide. All right, so here's our current tax rates for 2025. And if you see, it does not take much to get you up into that 22% bracket or that 24% bracket. And then, Preston, let's go to the next slide. Then we've got our states. And for our folks in Virginia, you folks are going to pay significantly less in taxes than us in Maryland, even when you include your personal property tax that you folks get to pay that we don't have to pay. But you folks in Virginia are definitely a little bit better off than us Maryland and DC folk. All right, Preston, let's go on. So I've mentioned two taxes so far, your federal income tax and your state income tax. Then, because you folks are all self-employed, you get to pay the employer and the employee side of the Social Security tax and Medicare tax, what we refer to as the self-employment tax. Of that, 12.4% is the Social Security tax. Medicare is 2.9%. If you were employed, your employer would pay half, and then you would pay half. But since you folks are self-employed, you get to pay both sides. All right, Preston, next slide. And for anybody confused, I am Preston Hall, and the person changing the slides is also Preston Hall. So, all right. So let's add it up. We've got our federal tax, we've got our self-employment tax, which is made up of two taxes, and then we've got our state tax. So we've got four taxes that we pay. All right, and then if you're in Maryland, you're going to be, if you're in that 22% bracket, you're going to be paying 45% tax on anything for which you don't have a business deduction. Now, when we think of deductions in our business, we like to look at those business deductions first because they reduce all four of the taxes. Whereas when people think of deductions and they think of their charitable contributions or their mortgage interest, things like that, that only reduces two of those four taxes. It reduces the federal and the state, and it does not reduce the two taxes of your self-employment tax. So first and foremost, we want to focus on your business deductions to save you the most amount of money. Let's go to the next slide. Talk about that a little bit. So we've got deductible expenses of our personal home, and a lot of people think of this as a great deduction for them, but right now we can only take the interest paid on the principal up to $750,000. We can have two properties just so that in aggregate, the interest that we're writing off is not more than that $750,000. Then we've got our real estate taxes, but we also have the SALT limits of $10,000 a year, and that's the state and local taxes. So between our real estate taxes and our state income tax, we can only write off up to $10,000 a year. I believe that we will get some changes on this because this is unpopular on both sides of the aisle. So I'm hoping that we get at least an increase in SALT limits in the near future. Now, these things, these taxes and these write-offs with your primary home, for most people, it's only going to reduce two of those four taxes that we mentioned. But with proper planning, and we all have our office and home, Preston, next slide, we can write off our office and home as a business expense. And so this, if you have an accountant, and I rarely tell people to fire their accountant, but if you have an accountant who has been telling you that office and home is a red flag for the IRS, you probably need to fire that accountant. It's not been a red flag for the IRS in 1999, that's when they changed the law. And in, I believe it was 2016, the IRS said, not only is it not a red flag, but we're going to make it easy on you, and we're going to give you a simplified method to do your office and home, so you don't need to worry about those cumbersome worksheets. The simplified method is not the way to go. You're going to save significant more money in taxes if the office and home is done properly. Let's go ahead. So if your accountant is currently taking the simplified method, you may want to discuss with them, even if you have to pay them more, it'd be worth it to go ahead and have them do it properly on the form 8829. I don't ask people to take notes when I'm speaking, but the 8829 form is probably something good to write down and just look at and see if it's in your last year's tax return. If we have an office and home, we can write off against all four taxes a percentage of our mortgage interest, our real estate taxes, our insurance, which wouldn't have been deductible against any taxes before, cleaning services, repairs, utilities, HOA, condo fees, and if you don't own and you rent, we can write off a portion of your rent. So this is a significant deduction for, and is deductible against, basically, what we do is we take the whole house and the office and home, whatever the office and home is a percentage of the entire house. So let's say it's 10 or 20%, we get to take 10 or 20% of all of these expenses and write it off as business expense. So off the bat, this is typically going to save my clients somewhere between $1,500 and $3,000 a year in taxes. If you rent, it often is even better than that, because a lot of my renters, they're renting a place that's 1,000 square feet, and then the office is going to be 150 square feet. So it ends up being a pretty big percentage, and rent's expensive. So we get to write off all that rent. Now, not only do we get the savings of having the office and home, next slide, question. Let's see here. Okay, let's go to the next slide. But if your office is in your home, then we have no more commuting with our vehicle. And realtors do a lot of driving, or at least traditionally, realtors have done a lot of driving. And if you don't have an office and home, then your first trip of the day and your last trip of the day is a commuting expense, and it's not business vehicle miles. Commuting expenses are not deductible. So if you don't have an office and home, but you're writing off 80% of your business, of your vehicle as business use, it's almost impossible to get to those numbers, because you have, your first and last trip of the day is not deductible. But if you have an office and home, then you can justify having those higher, that higher percentage business vehicle use on your vehicle, because what's the first thing you do when you get up? Everybody goes, checks their email, and then you go off and you either show a property or go into the office. So now you're going from one business location to another. You finish showing properties, and you got to go back and either do some research on your computer, or you have to send off a proposal. So you're going from a listing back to your home to do some more work. You're going from one business location to another business location. Deductible. It is nearly impossible to justify business use of a vehicle to much more than 50% without having that office and home. So that's how not having an office and home can be a red flag for you. Okay, so one question I get a lot is, if I have a business vehicle, is it better to write off mileage or actual expenses, and do I have to track my mileage? In both cases, you have to track your mileage. If you're taking a standard mileage rate, we need to know how many miles we're writing off. If we're taking actual expenses, we need to know what that business percentage is of your vehicle to go ahead and write off. Now, traditionally, the standard mileage rate was about 50 cents per mile, and 90% of the time, it was going to be much better to take the actual expenses, because we could not only write off the gas and repairs on the vehicle, but we could depreciate the vehicle. Standard mileage rate now is 70 cents a mile, which is pretty significant. And so if you have a very reliable vehicle, or a very fuel efficient vehicle, or an inexpensive vehicle, and you're doing a lot of driving, that standard mileage rate may be a better way to go. We typically do a calculation of both, and then we do the one that is more beneficial for the client. Now, if you start with actual, you're going to want to stick with it, because if you go ahead and switch to standard later, we have to recapture any bonus depreciation we've taken. But typically, what is good for the person in the first year of having, that's okay, Preston, you can go on to the next one. But typically, what's good for a person in the first year or so is going to be the best way to go going forward. This 70 cents a mile is kind of a game changer though. If you are taking standard mileage rate, we can still take the interest on your car loan as business expense, at least the business portion of it. Parking and tolls, business parking and tolls, we can do personal property tax for those of you in Virginia. Now, lease versus purchase, I won't drill down into this too much, but for the most part, purchase has been better, a better financial decision for years. But now with a lot of these electric vehicles offering ridiculously low lease rates, only because the manufacturers can't sell these electric vehicles and they're leasing them for $200 or $300 a month. Well, it might be better to lease one of those for a few years just because they're taking the financial hit just to get it off their lot. So just something to think about. Also, with the lease, the $7,500 credit that we mentioned earlier, that gets wrapped into that $7,500 gets wrapped into the lease, which is one of the reasons they're able to bring those lease prices down. But for the most part, the car companies are just taking a hit because they need to get the cars off the lot. All right, next one, Preston. We can skip that one for now. Investment property. So here's one reason I definitely don't want you folks giving advice to your clients, because a lot of times people will say, oh, you should get an investment property. It's going to be a great tax deduction for you. Well, if we have an investment property and it's showing a loss, but our client has income over $150,000, they're not allowed to take those losses. Those losses are held in advance and they get added to the basis for when they go to sell the property later on down the road. So the last thing we want to do is tell a client that they're going to be saving money in taxes by buying this property, and then that client who's able to afford rental property probably makes over $150,000, and then they can't take it, and then they're coming back and suing you, or they're not going to use you for subsequent properties. So if somebody's looking for that kind of advice, you need to send them to an accountant. What I'm going to tell them is you need to think of rental properties. The best way to think of rental properties is a way to build equity. It's not, and it's done so in a tax preferred method. It's not going to save you a lot of money in taxes, but you shouldn't be, if it's done properly, it's not going to cost you a lot of money in taxes. It's going to be a great way to build equity, and you're going to be doing it with somebody else's money, and you're probably not going to be paying a lot of taxes on it unless the person is purchasing the property in cash. All right, let's go on. How are we doing on time? All right, that's good. I know this is pretty dense, and like I said, I'm happy to answer questions. You can also reach out to me. I'll give you my website at the end here. You're more than welcome to reach out to me if you have some questions and want to talk to me later. We can set something up as well. So, are there exceptions to that $150,000? Yes. As real estate professionals, you folks have the ability, if you were going to be managing that property, if you're going to be managing that property yourself, doing more work than anybody else, you have to do 750 hours of work associated with the property each year. But if you're going to do that, then as a realtor, if you have a loss on that property, you are allowed to write off that loss against your income. It's going to save you on 2 of the 4 taxes. It's not going to save you on your Social Security tax. So that is something that you have that option. Oftentimes, for most of my clients, I don't recommend it unless they understand the ramifications. And the ramifications are you're going to be building that equity, but when you go to sell that property later on down the road, if you don't do a 1031 exchange, then you are going to have a significantly higher tax bill because you were able to take, $10, $15, $20,000 in losses each year on this property. So you're going to pay those taxes on the back end. So if the idea is to own that property for the sake of building equity and you want to sell it off and retire with that money, or you want to sell it off, put the kids through college, or what have you, then you don't want a big tax bill later on down the road. If the idea is to purchase that property, build that equity, bring in as much income as possible, and then you're gonna 1031 exchange it, or your children are gonna inherit it. Well, great, write it till the wheels fall off, because with the 1031 exchange, there's not gonna be any tax bill associated with it unless you're purchasing a property that is less than the property you are selling. Or in the case of kids inheriting it, they get a stepped up basis, so whatever the property is worth at the date of death, then that's their basis when they inherit that property, and therefore, if if they were to sell it the next day, there would be no tax bill owed, so. But all of this requires proper planning, and it's things that you need to think about, depending on which strategy you're going to take. For the 7-day rule, you can write off losses on the property. This is with your Airbnbs. This is if the average rental is 7 days or less, then it has to be treated as a business. And so that's another thing I can talk about 30 minutes on that. So just something to think about. All right, Preston, let's go to the next slide. Here, just a quick example. And so when I mention those losses on a property, just because you're showing losses on a property each year doesn't mean that you're necessarily coming out of pocket. So if you're looking at our tax profit and loss, this is the same property, the same amount of rental income. If we look on the right-hand column, that's what we're going to show and just take a look at the numbers briefly. But if you take a look in the on the right-hand chart, that's what we're going to show on our tax return. We're showing a $5,000 loss and those are the expenses that we can take against the rental property. But what happened in reality? Well, here's our cash flow. We've got that $45,000 of rental income. And then at the end of the day, we were able to put $5,000 in our pocket once we subtract all the expenses that we actually paid on this property. So even though we put $5,000 in our pocket, we were able to write off a $5,000 loss. And what's responsible for that $10,000 swing? Well, we've got depreciation, which didn't cost us anything, but we're able to write it off on an annual basis. And because we've got that depreciation, we are showing a loss where we actually had a profit. Some of the stuff on the cash flow side, we can't necessarily write off. But we got that depreciation of $15,000 in this case. And $15,000 is about what we're depreciating on most properties. It's typically going to be between, $10,000 and upwards, depending on what the property is worth. Let's go to the next slide, okay? All right. S corp. Here's the most important thing you need to know about S corps. Is we close more S corps than we open. S corps are expensive and complicated, and accountants push their clients into S corps far too early, we find. And so typically we want our clients to be making $180,000 of net income after all their business expenses. We want our clients to be making at least $180,000 net income before we're going to look at putting that client into an S corp. And that's not for 1 year. We want a client who's on an upward trajectory, and so we believe that they're going to be making that amount of money in the future as well. Because there's so many expenses associated with doing an S corp properly that we want the amount of tax savings to not only outweigh the expenses, but outweigh the pain in the butt factor of maintaining that S corp. So a lot of clients will be in real estate for a year or two, or a lot of individuals will be in real estate for a year or two, and then either their cousin or a accountant who, I'm not going to say disreputable, but just an accountant who's not really thinking ahead in the client's best interest we'll push clients into an S corp before they're ready to, and so the account makes more money, but is the client saving any money? They may not, and if they are saving money and not making that much money to begin with, then it's probably being done improperly. So, just something to think about. If somebody is, if anybody's pushing you into an S corp just because they know you're self-employed, that's not advice you want to be taking. You want to talk to an accountant who's gonna go through the advantages and disadvantages with you of having that S corp and explain to you, it can explain why, you know, it takes a significant amount of income before it really is worth having that S corp. All right, give me the next slide, Pete. And so let's see here. Retirement accounts. I know a lot of my realtors, and I don't blame you, their retirement account is their rental properties that they have purchased over the years. And that's what they're using to retire. But I've got, you know, 10–15% of our clients are putting away a significant amount in retirement accounts each year. Most are putting them in SEP IRAs, but what we prefer, Preston, give me the next slide, is gonna be the self-employed 401k. And there's a number of reasons we like the self-employed 401k. We don't sell these. I'll give you a list of 3 or 4 other people, if you're my client, that you can go to. You can go set one of these up with E-Trade even, or, you know, one of those self-help investment services. But almost every investment house these days will offer a solo 401k. There's a little bit more compliance with the solo 401k, not much. Mainly if you have more than $250,000 in the account. But why do we like the solo 401k? There's 3 reasons. One, you can put the most amount of money in the solo 401k, the self-employed 401k. So that's great, except for a lot of my realtor clients aren't putting that, they're not putting the max in. So, okay, that point's kind of new. Another reason we like the solo 401k is, let's go to the next slide here, okay? Is federally protected 100% from creditors, lawsuits, and bankruptcy. For those of us who were alive in the 90s, will remember there was an NFL player accused of double homicide. Did not go to jail, but he lost a civil lawsuit with, and all his money was lost in that civil lawsuit, but continued until the day he died, and he was living in nice houses and playing golf every single day. Why is that? This man named Orenthal James Simpson had a 401k with the NFL, and you can't take that away from people. So that's why we really like the 401k, is it offers you that level of protection that you don't necessarily have with the SEP IRA. Now, you know, not a lot of my clients are getting sued and getting their money taken away, but best reason to have the solo 401k is we can take a short-term loan from the solo 401k. If we have, and I've had to do this twice, both of my offices that I own now, I didn't have enough cash when I went to purchase those offices for the down payment, and so I took a loan from my 401k to purchase those offices. And now I have 2 offices that are, you know, I'm growing that equity in those offices. And I wouldn't have been able to do this if I didn't have a solo 401k. So you can take a loan from your solo 401k, you're gonna pay interest on that loan, but who are you paying interest to? You're paying interest to yourself, okay? So you get to keep that money, that interest. Unfortunately, you're taking pre-tax dollars and paying it back with post-tax dollars, but this is not something you do to go to Disneyland. This is something you do because you need money for an investment that is a no-brainer. You don't have the cash, but you do have this tool that you can use to pull money out. All right, Preston, go to the next one. So you need $10,000, you borrow it from your 401k, what do you have? You have $10,000, you have to pay it back, all right? You take $10,000 out of the SEP or an IRA, you're in the 24% bracket, you pay $800 in state tax, you pay a $1,000 penalty for taking it out. You only get of that $10,000 after you go to pay your tax bill, you only get $5,800 of that. So I know which camp I'd rather be in. I gotta pay back the money to myself. I'm gonna borrow from the solar 401k any day of the week, so. Let's go ahead, Preston, to the next slide, where are we? End of the year, well, we're past the end of the year, unfortunately, but things, yeah, you agree with that, Pendleton? Yeah, we're at the beginning of the year, but here's a couple things you can think about if you make too much money this year. If you have rent or expenses associated with your with your business, you can pay up to a year's worth of expenses. Business expenses, remember, we're talking about business expenses here. But we can prepay up to a year's worth of expenses and write those off. So if we've had a stellar year, that's something we can do. We can also look at making a large equipment purchase, whether it's, you know, a copy machine or a vehicle or what have you. These are great ways to go ahead and cut down on our tax bill on money that we're gonna need to spend anyway. We can shift income into the next year, and this is where if we have, for you folks, if you have a settlement that's gonna occur towards the end of the year, maybe you wanna schedule that settlement for January 2nd or January 3rd, if it's originally supposed to be on December 27th. Maybe you can push it, so that you get paid, in the subsequent year. Let's see here, what else? You can look at putting money into your retirement account, HSA deductions for those of you with high deductible health insurance plans. I love high deductible insurance plans. I love that HSA deduction because you put money in your HSA account, you get to go ahead and write that money off against 2 of the 4 taxes, in conjunction with the fact that you don't have to spend that money. You carry that money from year to year, as well as in most accounts, they allow you to invest it. So that money can be not only, it's growing just like it would be in your retirement account. And this is better for people who don't have a ton of medical expenses and you have those high deductible plans, so that this way, when the medical expenses do come up, you know, you've got the money in the HSA, so you can pull it out if you have high deductibles. What else do we have? Yeah, those tax credits that I talked about earlier, and then tax loss harvesting with your securities. If you have losses in your security accounts, you may be able to sell those. If you remember, don't repurchase the security for over 30. You gotta wait at least 31 days to repurchase it. Otherwise, it's called a wash sale, and you can't take that loss. Okay, let's go ahead. Preston, let's go to the next slide here. So, our website formatting looks kind of weird on here, but is tax-masters.com. And if you want to get in touch with us, you can just send an email, say that you saw me at the speech, and we'll get back to you at tax-masters.com. Just go ahead and shoot us an email if you want to discuss a tax situation. Any of you, I'm glad I just remembered this. Anybody who's a couple years behind in taxes, I just hired an accountant. She's got 25 years experience. She loves working with multi-year non-filers. So she can, you know, it's typically something that I'm reticent to take. We do a lot of multi-year non-filers, but we do them in the off season. But now that I have somebody who kind of specializes in it, you know, even though we're going into our busy season, we can help you get taken care of. If you have, you know, outstanding balances and stuff like that, and maybe want to get on a payment plan, we can do that as well. So, all right, that's all my slides. Leave that up there. Does anybody have any questions? Anything they want me to extrapolate on? How am I doing? Oh, look at that.
That's good to
Yeah. So just unmute yourself if you have any questions. Otherwise, you know, feel free to reach out to me if you have something more personal you want to talk about. No? Okay. All right. Well, thanks for having me, everybody.
Let's see, is there somebody chatting? Somebody put something in
Oh,
the chat.
is there something in the chat? Yeah.
Here's my mouse.
We can do the stop share to make it a little easier.
Stop share.
Yeah, I loved it.
Can
Oh,
you move your cursor off the live caption? Okay, that was too.
too late.
Please say the form number for home office.
Oh, okay, the phone for the office is the 8829 form. And so the only reason that that's relatively complicated is not only do we have to take do we do all of your expenses, but we also have to depreciate your home. And the depreciation on your home is typically, you're only going to be writing off a few $100s a year, but you're going to be saving all that income tax on it. Will you have to recapture it later on? Yeah, but the recapture is going to be so small that writing off the office and home, doing it properly over the years is going to save you so much more money than a little bit of recapture when you go to sell your home.
Anybody else have any questions? Anybody unmute?
Hey, Preston, this is Tim Melia.
Yeah.
Could we jump back to one of your slides in the beginning of the presentation talking about the write-offs for HVACs and hot water heaters in home?
Yeah. And
Uh,
just click on the slides here, Preston.
We're not sharing, so we gotta.
Oh, we're not sharing. Okay, so we'll
Share.
reshare as well.
Yeah.
All right, so first let's go back, Preston. Yeah, go all the way.
Or maybe just keep clicking this guy for me. That's it. And then let's go and share. Click on Zoom. Yeah. All right.
Yeah,
Let's see here, with the heat pumps, hot water heater, yeah, let's see here. What did I want to tell you about this? So we can
Yes.
write up to $2,000. It's gonna be 30% on the heat pumps, the hot water heater. One thing that's interesting, although nobody does this anymore, but I got one this year. It's my fireplace, it was never converted to gas. It's regular wood burning fireplace. And so I put what's called a wood burning insert in there, so I still get to burn wood. What this insert does is it's insulated, and once the insulated area heats up, it turns on a fan and it heats up my house. About 75% of my house is heated just with running a fire. And so it's really nice, but it's also energy efficient enough that I'm able to take a credit on it. So I bought. I did two things this year. I got the hot water, a heat pump hot water heater, which those are kind of expensive. A typical hot water heater is going to run you like $600 to $1,000. Mine with a bunch of discounts from Home Depot was still like $1,700. But it's super efficient. It also does a great job of it dehumidifies the basement because mine's in the basement, and so it's really kind of cool in conjunction with the fact that I get to take a credit on it as well. So I'll be maxing out that $2,000 this year. I won't be able to do the full 3,200 because I didn't get any windows or doors or have a home energy audit. But I saw these and I was like, well, there's a couple things I want to do. So that'll be a nice little treat. Was there something in particular you had a question on?
I was wondering if it prompted people to make a change from like a gas furnace system to a heat pump, because your reference here is just heat pumps.
Right. Right, so if you're making that conversion, then just about any heat pump is going to be efficient enough for you to be able to take that credit. So, if you're putting in, you can take up to 30% up to that $2,000 there. So if you're doing even $10,000 worth of work, which apparently is nothing these days when it comes to heat pumps, then you're going to be able to max out that $2,000 credit.
So buying a gas furnace again would not be eligible for this kind of credit?
You know, I look, with this credit, because it's so complicated, I look it up each and every time. If you send me an email, I'll be happy to take a look at whether, because certain, it really depends on the system, but, certain system, it's one, like I said, it's so convoluted, that I usually have to look at multiple places before I give anyone any clear advice on this, but there may be, you may be able to do it with the gas system, provided it's efficient enough. Or if it's a hybrid gas system where it utilizes a heat pump most of the time and then uses the gas as emergency heat. I'm pretty sure that you're able to do that with those.
Okay, I'll send you an email.
Anytime one of these comes up, even internally, there's 12 of us at my firm, and we send it out and we're like, is this available? And we'll read them all over and over. And it's like, yeah, I guess let's try, you know? It's really written, it's about as clear as mud, the way that it's written, so we read it over and over again each time we're looking at something, having to do with this.
Thank you.
If you're doing this work anyway, it is nice to have that as an option.
Yeah, thank you.
Sure. Anybody else have any questions? All right. If no one has any questions, I guess we'll,
Yep, that's good, and, thank you, everybody, and, thank you for Tax Masters, for coming and speaking to us today. And I think we'll hit the streets. If anybody has anything that they need to discuss, I'm here as well. But everybody else can, check out, and we'll have a good, productive day.
Thank
Thanks,
you.
thanks, Preston.
And
All right.
Preston too.
Bye, kids.
steal my battery. Yeah, she gets shut down. Yeah. I get shut down.